Welcome back to the stream. My name is Brian Dean. We are doing episode 5 of the Almost Friday weekly live seminar. What this is a free live investing seminar with me, Brian Dean. I'm a former investment banker with a Master of Science in Finance, and my goal on this channel is to help you master the market. So we've got a little bit of a new format for this week. I've got an agenda that you can see here on the left, and I'll just transition my camera. That was really cool, wasn't it? So we've got an agenda with what I plan to talk about on today's video. Feel free to skip around. I will put in chapter markers if you're watching this after the stream, if there's a specific topic that you want to hear about. And then, of course, if you have any questions at all, feel free to ask. I can see the chat over here and we can cover them during the stream. So let's start off with some news that we got this week in terms of tariffs. And I'm sure anyone who's watching this, who's investing, who's got money in the market is probably wondering what is going on with tariffs. What is the situation? Are any deals being made? How many countries are we negotiating with? Are tariffs in place? Are they not? If so, what percent are they and what do they affect? I'm not going to go through a deep breakdown of every tariff that's in place in the US, but one piece of big news that we got this week was an announcement of a deal between the United States and the United Kingdom. And you can see I've got this article here from CNBC outlining that this deal sends a clear message that 10% tariffs are here to stay. Now I'm going to pull up an image for you in a second that I think summarizes this deal very clearly, especially in relationship to the broader situation that we have as a country. And it's going to show you why I think this deal was as a lot of folks would call it, a nothing burger. There really isn't a lot of substance to this deal, but I think we should go through some of the key points here in this article, and then we can take a look at that image and move on from there. So the deal, as I mentioned, was between the US and the United Kingdom, and it will still be subject to a 10% baseline tariff. What this means is that even with a deal in place, goods will be 10% higher coming from the United Kingdom, which will be paid for by US businesses, and those businesses on average will likely increase their prices to cover the costs of those tariffs. And it's important to note that this is a minimum, and this is not a necessarily set in stone deal. This is, we are in an environment where we have an administration, we have a leader of the United States who has demonstrated a propensity to change his mind at a moment's notice. So in the future, if let's say, President Trump wakes up on the wrong side of the bed, so to speak, he could, or someone from the UK says something that he doesn't like, he could, in a heartbeat, increase those tariffs from 10% back up to 15%, 20%, 45%. Nobody really knows exactly what the next step's going to be. But this is the deal that was outlined here. There were some concessions made back and forth in terms of vehicles made in the UK, but someone put this example really well. One of the vehicles that this covers are Range Rovers. And what this means is that there is now a 10% tariff on Range Rovers, down from the 25% rate, but we imposed this rate on them in February. Before that, there was a 0% tariff on Range Rovers. So after everything that's happened, there is now essentially from 0% up to a 10% tax on vehicles that are made in the UK, one example of which being Range Rovers. So regardless of this deal, which my understanding is this isn't actually set in stone. This is an announcement that a deal is going to happen. This is not a deal that is taking place right now. It's not like the tariffs have gone down today. It's that when this deal is made at an indeterminate time later this year, these are the terms of the deal. Now I want to show you the image that I alluded to. This is from Reddit, and this is a screenshot from Donald Trump's Truth Social account. And this summarizes exactly what's happening with this deal. So we are getting new market access on $5 billion of imports. What does this mean? This means that the UK is going to be buying $5 billion more worth of goods coming from the US. So just to put this generally, let's assume that the US is now getting exposure to about $5 billion, and we're going to assume that this is an annual rate. Of course, it's not clear here in the image. This could just be an estimated long-term rate, but we're just going to assume that the US is getting another $5 billion a year from the United Kingdom. Additionally, there's $6 billion in external revenue coming from tariffs. Now, I want to make it clear that this is revenue that the US is collecting from US companies that are purchasing goods from the United Kingdom. So in that sense, it kind of is like a tax, but I'm going to be, again, very generous. I'm going to assume that we are going to realize this $6 billion number, and this is going to be every year. So going forward, as part of this deal, this proposed deal, the United States is going to be making about $11 billion more dollars per year. And the goal of these tariffs is to make America the wealthiest economy in the world, right? And we've got some other summary data here that UK tariffs are now 1.8% and US tariffs are now 10%. And they were 3.4% before. That's on a blended basis across industries. So $11 billion, but let's see how that looks in comparison to our total US deficit, which is the one of the main financial policies that we're trying to combat against. And we can see here that the fiscal year 2024 deficit is $1.83 trillion. And of course, we are in the year 2025. And that is expected to increase the U.S. deficit, much to potentially your surprise as a viewer. The U.S. deficit, despite all of the rhetoric that we've heard across the news and from the Republican Party, and I don't want to make this a partisan thing, but the message that's been sent to us as citizens, as investors, is that the deficit is going to come down. We have yet to see that. And the point that I want to make here is this deal that's been made with the UK is very small in comparison to this deficit. So this is $1.9 trillion deficit. That's 1,900 and change in terms of billions of dollars. And so $11 billion per year is around under 1% of that. 1% would be about $20 billion deal, but this is an $11 billion deal. So does this move the needle? No, it really shouldn't. And I think the stock market, I think investors appropriately priced this deal. We had a lot of volatility this week, but I think you can see where we had these big movements up and down. The entire week, the president was alluding that a deal was going to happen, which would send markets higher, and then there would be speculation as to what the deal was going to be. And then the deal got announced, and the market shot up, 1.5%. And then later into trading, as folks got to digest the deal, the market went back down another 0.8%. And there have been a lot of things happening this week that have sent markets up and down. So I think the market is appropriately pricing this deal, and is the reason why the market is largely flat for this week and is probably going to close up under 0.5% or so. So that is one update on tariffs. The additional one that I want to mention too is that, and I want to bring some reality to these headlines, because there are two things that are happening. These headlines are coming out at investors very quickly, and they're also coming with a lot of assumptions being made. There are a lot of gaps in the facts that are coming across in the news that's hitting your feed, your notifications, that's circulating on Twitter and your other social media accounts. So I want to make sure that we have a dose of salt, so to speak, a dose of reality when we watch these headlines. So let's walk through this. Trump suggests cutting China tariff rate to still high 80% ahead of Switzerland talks. Now, when I read this, at least my assumption was, and yours might be as well, is that the takeaway is that Trump is suggesting that we lower tariffs from 145% down to 85% before talks begin, in an effort to bring China to the table as a sort of first move. Anyone who knows anything about a negotiation is probably going to have an opinion that that is not a good move to do. You don't want to be the first one who makes that move, because then the person on the other side of the table is just going to sense a lot of weakness. They're just going to wait for you to lower tariffs again and again until you get to a point where you have very favorable negotiating conditions. However, that is likely not the case. And I think CNBC finally updated their article, because it did not say this before, to where they mentioned it is unclear if Trump wants the 80% rate to be the long-term tariff for China, or whether it should be viewed as a step in negotiation. So that second point is what I was just referencing. But the first point is the alternative. And I think it aligns much more with what he actually said. In his Truth Social post, Trump said 80% on tariff on China seems right, up to Scott B. or Bessent. Scott Bessent is the U.S. Treasury Secretary, and he is one of the U.S. officials that is going to be speaking with Canada at a meeting in Switzerland to start negotiations, or as some would say, to start negotiations for the negotiations of the deal, because we really don't know where we are in these trade talks. And so my interpretation of this tweet was actually relatively bad news. What I see this coming after the UK deal that we just mentioned is that the UK deal sent a clear message, which is that 10% tariffs are here to stay. So tariffs have gone down from where they were when they were set at 25%. But before this all started, pre-February 2025, they were 3.4%. Now they're 10%. So my interpretation of this is that Trump is saying that in a deal with China, he wants tariffs to be set at or around 80%. Some investors were expecting or hoping that it would be 50% or less. Some were even there were even rumors circulating across headlines that this reduction here was going to be announced by as early as yesterday or today, and they thought that it was going to be a 50% cut ahead of negotiations, and the market went up on that news. And then Trump announced that it was that. Then he posted this to Truth Social. He said he thinks it should be closer to 80. And so that is the update that I want to give you today. I hope that gives you more information from the perspective of an investor on what is going on with the tariffs. So just to summarize, we've got a preliminary deal with the UK, nothing set in stone, which mentions that 10% tariffs are here to stay. It's bringing in optimistically about $11 billion per year in revenue, which should help out our fiscal deficit by around 1% or I think under 0.5%. So overall, not a lot of news here. And in my opinion, the stock market has been pricing this appropriately because for the last week, even though we've had a lot of volatility, overall prices are pretty flat from from Friday through today. In fact, they're even down from the end of last week. All right, let me go ahead and mark this off of our new list. I'm going to put this in green highlight just to mention that it's covered. Next, I want to talk to you about the Federal Reserve. So for those of you who may or may not follow markets, we got a statement from the Federal Reserve. If you don't know who the Federal Reserve is, they are an independent body that sets baseline interest rates for the economy. They have two goals, it called a dual mandate. Their goal is to increase employment and keep prices steady. They're okay with some inflation, but they want to keep inflation around 2%. As you've seen on my channel before, I've highlighted that unemployment is on the rise and inflation is higher than it should be. It's currently around 2.5% compared to their target of 2%. And the Federal Reserve has not been able to get inflation down to that 2% level. And now they're fighting an uphill battle against tariffs and other supply shocks to the system. So when we as investors look to the Federal Reserve, they hold these press conferences where they speak about the economy. Of course, they're very close to the data. They have access to data that you or I don't necessarily have. And they give a summary of how they see the economy performing over the past quarter and currently, and they also look forward a little bit. And as opposed to watching the whole 50-minute interview on YouTube, what I want to show you, my viewers here, what you can do is a lot of news outlets, including CNBC, will post what's called a red line. They will show you everything that's changed from the last Fed statement to the current one. And what I think is really funny about this is this really important Fed statement is very boilerplate. You can see all of this black text that's here. I'll zoom in for you in case you can't see it. All of this black text here is the same text that the Fed used in their statement from the previous session. And the red is everything that's changed. You can see some things have been crossed out completely, other things have been added. So we're going to go through really quickly and give you a summary of what's changed from the Fed's policy compared to the last meeting that we had. So the first one is that swings in net exports have affected the data. Why have net exports been swinging? Primarily because of tariffs. So over the first quarter of this year, when companies saw that tariffs were going to be put in place later on, starting in April, and then of course we got a 90-day pause, a lot of companies started front-loading their supply orders. They started ordering all of the goods that they needed at the current prices before the tariffs went into effect, and this created a huge surge of net exports. So that's where and what ends up happening as a result of that is it starts muddying up the data because you get these huge spikes and drops, and it becomes hard to see what the underlying growth of the economy is like. And so the Federal Reserve has noted this, that it's created a lot of fuzziness in their forecasts and in their view on the economy. And that is driven primarily by tariffs. And they go on to speak more about tariffs in their statement, and more so in Jerome Powell, who's the head of the Federal Reserve, in his speech following the Fed statement. So just to double down on that, they mentioned that uncertainty about the economic outlook has increased further. So it had already increased before, and then they added to the statement that it's increased even further, and that they are attentive to the risks of both sides of its dual mandate, and judges that the risks of higher unemployment and higher inflation have risen. Usually, you see one or the other. You see unemployment going in the wrong direction, or you see higher inflation going in the wrong direction. Why does that happen? Because when folks have jobs, their wages increase and they buy more goods. So unemployment is low, but as they buy more, companies raise their prices to make more money, and that drives inflation higher. And vice versa, when people start losing jobs, they have less money to spend on goods, and that can drive inflation lower because companies are losing money at current prices, and they start decreasing their prices and finding ways to entice consumers to buy more goods, which leads to deflation or lack of inflation. And so in this circumstance, we actually have risks to both sides of the Federal Reserve's dual mandate. And they've said so right in their statement, which I think is very interesting to see the Fed do. Usually they're a little bit more conservative in their language, but they're just coming out and straight up saying, hey, we think there are risks here to potential stagflation. For those of you that don't know what stagflation is, that is a combination of stagnant growth and high inflation. And that is very difficult for the Federal Reserve to handle because they have one primary tool, which is increasing or decreasing interest rates, which lowers or increases the cost of money. When inflation's high, they'll typically increase interest rates to get people to spend less money and bring inflation down, and vice versa for inflation. When unemployment is high, they'll usually lower interest rates to soften the blow on households that are getting less incomes and need to be able to spend more money. So when both are going in the wrong direction, it's difficult to choose one or the other. Do you tackle inflation? If so, you're going to have to raise interest rates. You're going to increase borrowing costs. You're going to remove capital, remove money from the system in an economy where people are already losing their jobs, they're having less incomes, and the last thing they need are higher interest rates. Or do you go after unemployment? But if unemployment's going up, then you want to lower interest rates. And if you lower interest rates, that's going to give people more money to spend, and inflation is going to go out of control like we saw in 2002, 2003. So all I can say here is this is one of the most interesting times to be watching the Federal Reserve. I think that currently they held their rate steady. I think they're making the right call. They're taking a wait and see approach. They want to see how far we go with tariffs, what those long-term tariffs look like. And I think we'll see a lot more reaction from the Federal Reserve once we have more certainty about our economic policy with respect to tariffs and global trade. So that is the update I wanted to give you on the Federal Reserve. And of course, if you're watching this live, feel free to throw some questions. I'm going to assume that I've been describing everything perfectly well because we haven't had any questions so far. I need to rapid fire through this because we've got about 5 minutes left before the market closes. The next one, I just want to give you a brief update on Bitcoin because I know I get a lot of questions in the channel about my thoughts on cryptocurrency. And I will say that objectively speaking, Bitcoin has been a fantastic asset year to date. Year to date, Bitcoin is up over 10%, and it just crossed back above $100,000 per coin. And compared to the S&P 500, the performance speaks for itself. You can see that year to date, the S&P 500 is down almost 4%, whereas Bitcoin is up 10.44%. Now, there are a few points that I want to make here. The first one is that I would not say that this makes Bitcoin a hedge against market volatility in any way. In fact, you can see the leverage versus the S&P, or what we call it in the investment industry, beta, where when the S&P is going up, Bitcoin goes up even more. When the S&P goes down, Bitcoin goes down even more, and vice versa. When the S&P goes up even more, Bitcoin goes up even more. So this is not necessarily a hedge in the same way that something like gold or bonds might be. I'm going to pull gold up. You can see that gold does not have much correlation here. It's just going up, up, up. It's going in a straight line. And then same thing for bonds. I'm going to pull up, we can just do BND, which is the Vanguard Total Market Bond Fund. Again, you can see just a straight line across the board. So I would not say Bitcoin is any kind of hedge towards volatility, but it's performed quite well year to date. Now, one question I want to answer is, would I hold this in my portfolio? I personally would not. I don't think there's a lot of utility to owning Bitcoin itself. I see it more as a digital collectible. There's a limited amount. It is the first, large cryptocurrency. It's the most mainstream cryptocurrency. Folks might want to buy one while they can. It'll be a novelty to own in the future. But the technology is really in the blockchain, not in Bitcoin itself. So if you are viewing Bitcoin as a collectible, if you want to get to a point where you own 1 or 2 or 3 whole Bitcoins and hold those in the future, and you think in the future they're going to be worth more because, you know, supply of Bitcoin is going to go down, and it's going to be, you know, really cool to have ownership of a whole individual Bitcoin, then I would say by all means invest some money into Bitcoin. If you have $100,000, I wouldn't make it more than 5 or 10% of your net worth or your whole portfolio. But by all means, if you are within that net worth, if you have $1 million or $2 million more in net worth, and you are willing to take that risk and invest in Bitcoin long term, I don't think it's a terrible investment. If you have under that level, if you're still trying to get to your 100,000 net worth level, or 250,000 or $1 million, I personally wouldn't do it, just because there's too much volatility and there's always the risk that this asset could go to zero. I would not say the same for the S&P 500. That is a distinct difference between Bitcoin and the S&P 500, is that the S&P 500 doesn't really have a probability of going to zero. Never say never, but if the S&P goes to zero, we've got bigger problems to worry about. When it comes to Bitcoin, Bitcoin could absolutely go to zero. There is no 0% chance that it goes down to zero, and it doesn't even have to go down to zero for you to lose 90% of your money. If it goes from $100,000 per coin down to $1,000 per coin, which a lot of folks not that long ago thought was a large price per coin, then you're going to be down on your luck either way. So it's a very volatile asset, very risky. Not opposed to owning it, but it's not for me. So that is Bitcoin. Last, I want to talk about portfolio allocation and my buy the dip indicator. Since we are close to the market close today, we are going to pull up SPY, and we're going to put some Bollinger Bands on the chart. For those who are new to the channel or are new to the video, this is an indicator that I'm about to pull up that informs when I will be buying the dip in a big way. What this is a mean reversion strategy, and we're going to look at the 1 year or 52-week moving average, and we're going to look at 3 standard deviations below that average. And if the market closes below that line, which you'll see as a green line here in a minute, then that would be a signal to buy into stocks in a big way. And until then, I'm just holding my normal portfolio, which I'll mention in a second. So let's get these lines here. Also, I apologize that my voice is going out, but today's been a long day. So let's go ahead and close this out. We got our 1 year chart, 1 week, and you can see that we would need to get down to about a 487 level on SPY. So if you're interested in buying the dip on this market, I would wait for this level. I feel hesitantly optimistic that we could get back down to that level, but at this point, we're back to our longer term 1 year moving average. I would just hold a normal portfolio. The portfolio that I hold is about 60-40 stocks to bonds. That's my current preferred portfolio. And the assets that I hold are not Bitcoin. Let's go and refresh this. I hold SPY, which is the S&P 500. I hold AGG, which are corporate bonds. I do 60% SPY. I do 10% corporate bonds. I currently have 20% in gold. And I have another 10% in inflation-protected bonds. That's because I think there are a lot of risks to inflation going up in the near term, especially with tariffs. And so that is why I have some exposure to inflation-protected bonds. If we look at these assets year to date, they've all performed quite well, and everything in this portfolio has, of course, performed better than the S&P 500. And last but not least are international stocks, which is ACWX. That is all world international stocks ex the United States, because of course if you own some S&P 500, then you don't need additional US exposure in here. And of course that's been one of the best performing assets year to date. We're up 11%, more than Bitcoin. The only thing beating it really is gold. And so these are the assets that I hold. Again, the weights that I do 60% stocks split half and half between US and ACWI or international. So 30% in SPY, 30% in international. I have 20% here in gold, and then 10% between these two bond funds, 10% in AGG, and 10% in TIP, which is inflation-protected bonds. With that, I want to thank you for watching today's video. Market just closed about 1 minute ago. Let me know what you think of the new format with the agenda over here on the left, and I will see you in the next one.